Thank you, everyone, so much for coming to our webinar this afternoon. My name is Ty Robinson. I'm a community engagement specialist here at the Harvard University Employees Credit Union. I am joined today by our very own financial advisor, Raj Bhanshali here. And thank you so much for coming. Today's webinar is going to be investing Q&A. We're going to answer a lot of questions that were submitted ahead of time for today's presentation by attendees like you, as well as just talk about some of the more involved parts of investment services. Before we begin the meat and potatoes of today's presentation, I do just want to go over a couple of our webinar housekeeping things. I'm sure every one of us is very familiar with Zoom at this point. It's become a very integral part of all of our lives, especially for students, I'm sure. But for today's presentation, you guys don't have to worry about being muted or anything like that. You're all automatically muted, so please feel free to enjoy your lunch. Just kick back and relax. You don't have to worry about any audio coming in from your end. If you do have more questions during today's presentation or would like to ask questions that we're going to answer at sort of the end of the presentation during the live Q&A session, please feel free to use the Q&A feature of Zoom rather than the chat to ask those questions today. This is going to help us kind of gather them up and either sort of answer them live or save them again for the Q&A segment at the end of the presentation. And I did just want to make sure you all know that we record all of our webinars here at HUECU, and they are available for free on our YouTube page, which is My HUECU on YouTube. So please, if you want to do a rewatch of this one or take a look at many of our other different types of financial health and services videos, definitely take a look at those. There's hundreds of them on there, so please take a look when you get the chance. But who are we? So we are a credit union. We are the Harvard University Employees Credit Union. This differentiates us from sort of the big banks because we are a not-for-profit organization. What this means is that all of the members at the credit union are actually partial owners of the credit union itself. And that allows us to provide a lot more services and a lot of better features because we take the profit that we make and we give it back to our members. This is done in a lot of ways. For example, we waive a lot of fees for different things, including like ATM fees for other bank ATMs, stuff like that. We can provide better rates for different types of products and things like that. And we play a direct role in our community through individuals such as myself doing all sorts of things like volunteer events, charitable giving, as well as making sure that we listen to all of our members and communities' needs and provide great accessible products and services to everyone that we can. So definitely take a look if you're not a member yet. I do want to let you know that all Harvard students are eligible for membership here at the HUECU. And this is a great, great benefit for you, even if you have another bank that you belong to. When you have a membership with us, there are all sorts of products and services that are exclusive to you, including our online financial like growth platform, Thrive and GreenPath, some of our partners. We also have a lot of like classes and workshops you can take, webinars such as this that you can take. We waive a lot of fees, as I mentioned before, and membership is a lifetime membership. So even if you become a member here at the credit union and then decide later on to move your account somewhere else, you can always come back to us. Once you're a partner, we'd love to have you back. And this membership also does extend to your family as well. So if you open up an account with us in the future, if you have, some kids or some family members that would like to join up, we would welcome them as well. So anyway, enough about talking about the credit union. We're going to get into the meat of today's presentation. And I'm going to start by introducing Raj, who is our very own here at the credit union financial advisor. He works right downstairs in the branch we have right here in Harvard Square. And I'm going to talk a little bit about his bio here today. Raj Bhanshali works as a financial advisor with over 25 years of experience. Throughout his career, Raj has partnered with clients to help them identify their goals and dreams and then understand the financial implications of the life decisions they make. Raj is originally from West Hartford, Connecticut, and attended Northeastern University in Boston, Mass. Raj also works as a supervisor in event operations for the Boston Red Sox at Fenway Park. In his free time, Raj enjoys playing guitar and traveling. So thank you so much for joining us, Raj. I'm going to go ahead and kind of hand the presentation over to you. I'm going to ask the questions, and then you can go ahead and give me your answer for that.
Great. Well, thanks, Ty, and thanks everyone for joining. I can't think of a better way to spend a cold afternoon than talking about investments, so we can just jump right into it. And keep in mind, we'll have a Q&A after, so if you have questions, feel free to submit them in as you please. So yeah, I think we're ready to move on.
All right, Raj, so the first question we have submitted here today is, what is an investment portfolio?
Yeah, so we get this a lot. Investment portfolio really is, it can be anything, right? So anything that you have today, you're hoping will have value in the future. So the most common way to people look at portfolios are like stocks and bonds, right? So things that you find um, either in the stock market or in your fixed income institutions. But a number of different things can be considered investments, right? Like when I was a little kid, I used to invest in baseball cards. So hoping that one day those cards would be worth a lot of money. Apparently I was wrong because the cards I have are worth nothing, right? But what you're really trying to do with an investment portfolio is just making sure that the asset that you have today can sort of gain value in the future, because the whole point of investing is you're looking to combat inflation, right? So today's dollars won't have the same purchasing power as tomorrow or in tomorrow's world, right? So example I give there is when I was in college, I used to drink a lot of 2 liter bottles of Coca-Cola, and when I would go to the Stop and Shop or the Shaw's, I would buy a 2 liter bottle of Cola uh, for 99 cents. And now that same 2 liter bottle costs over $3, right? So it's still 2 liters. It's still the same process of making the Coca-Cola, but because of inflation and cost of goods and inputs and all that, the prices have gone up. So if I kept $1 in my pocket for 20, 25 years, I lost value there, right? So so the most common way to create an investment portfolios is with stocks and bonds, because you're hoping that in the future that those assets will appreciate. So, but that's really what an investment portfolio is. You're just having things that create value over time.
And that's like a group of things, a couple of like different types of bonds or stocks or things like that.
Yeah. So, and we'll touch on this later about asset allocation, but you want to have a good mixture of stocks, bonds, because they do different things.
Hmm.
They'll hit different buckets, and then you also want to talk about asset allocation, like and how you're investing. Like you are in equities, which are stocks, but how is that mixed, right? And then
Hmm.
you're in bonds, like what's that mix of bonds, right? So diversification is key, but there are many other factors, and we'll touch on that as we go through this, like your time horizon, your risk tolerance, and all that. But
Great.
yeah,
Yeah, somebody who owned a lot of Beanie Babies back in the day. I was hoping that those would also maintain their value, but
yeah, exactly.
unfortunately, that's not quite always how collectibles work. So,
Yeah.
okay, next question here is, when do you recommend using a financial advisor specifically instead of just like investing on your own?
Yeah, so that's a great question. So being a financial advisor, I will say you should always use a financial advisor, right? And working as a fiduciary, I think it makes sense to at least consult with a financial advisor, even if you want to do it on your own, because as a fiduciary, we're always going to bring to you what's best for you, the best solution for you, and for your goals, right? But really, if you want to do it on your own, you just got to make sure you're comfortable um, doing the research, knowing when to get in and or go in and get out of things. And some people do a combination of things, right? So like for their larger pool of assets, they want a financial advisor to help them with that. But if they have smaller like one-off things, they'll probably do it on their own. But we always recommend, even if you want to do it on, talk to someone first, right? Because
Mm.
there are insights that we can provide that most people don't don't get to see or they don't realize. Like I hate going to the doctor, so I'm always on WebMD looking for, like, oh, uh, I woke up with a sore throat. What does that mean? But then, if I misdiagnose it, I could really set myself up for a lot of pain in the future, right? So,
Yeah.
yeah. So, if you're comfortable doing things on your own, it's great. But you should always really consult with someone that uh, knows a little something about what's going on, like behind the curtains, right?
Hmm.
So,
Hmm.
I think uh, at least consult with an advisor before you do anything.
Good answer. Yeah. And you mentioned the word fiduciary. That's like a specific thing, right? For members in our audience who might not know the difference.
Yes, yeah. So as a fiduciary, I will work with you and so the nice thing about here at the Harvard platform is we're creating tailored solutions for you, right? So depending on your situation, your specific needs, we're going to bring you the best possible type of investment, the best possible solution. Like for example, we do have a lot of students that are members, and they'll come in looking for a way to get a better rate on their savings account, right? So they might have X amount of dollars in their savings account or even their checking account that they're not going to use immediately, but will need to use it eventually. So you don't want to take on too much risk. So my advice to them would be, and again, this is all, not in generalizations, but specifics, right? So if it's specific to your need, I might suggest, well, we have some great CDs here right now at the credit union. Why not put some of that money in a 6-month CD or a 9-month CD, right? Because that's the best solution for you. That doesn't do anything for me. That doesn't help me. So as a fiduciary, I'm always working to bring you the best solution, regardless of how the outcome affects me, right?
Yeah, that's great. And that's really important because I'm sure everybody wants to make sure that they trust the people that they're, getting advice from and making sure that the products and services are what's going to be actually best for them, right?
Yeah.
So,
and the reason that's important because, especially back when I started out, it was more of a traditional commission type business. So I don't know if you watched the movie Boiler Room and things like that. That was very real, right? So you have people would call you and say, "I got a great stock for you," and just try to have you put everything you have into that one stock, and that's not responsible. They're only looking for a commission, right? So that's sort of I don't see it that much anymore, but yeah, it's important that you have someone that works as a fiduciary.
Yeah, good to know. All right, next question here is what happens to the stock market when the Fed raises interest rates?
Yeah, so there's sort of an inverse relationship when it comes to rates, right? So we're in this environment right now where the Federal Reserve Bank has rapidly raised rates over the last 2 years. And the reason for that is because they're trying to hedge against inflation. And inflation we touched on earlier, like my 2-liter bottle of soda went from 99 cents to $3. So that's sort of measured inflation, but when you have like hyperinflation or rapid inflation, like which we saw post-COVID, again, going back to the supermarket. I spent a lot of time in supermarkets. A dozen eggs went from like $2 a dozen to almost $9, $10 a dozen. Part of that was supply, part of that was because of inflation, right? So in order to combat inflation, the Federal Reserve has a few tools in their tool belt, and one of them is controlling interest rates. So usually when rates start to go up, the stock markets start to pull back because there's an inverse relationship, and that has to do with managing risk, right? So for a short-term instrument like a CD, you can get almost 4.5% to 5% for a 6 to 9-month CD, which is a very good rate. So because of that, you'll probably see people move money out of their stock portfolio into something a little bit more short-term and stable, right? Because and if those that don't know how a CD or a bond works is when you put X amount of dollars, let's just say $1,000 into it, at maturity, so the end date of the instrument, you're going to get back your $1,000, right? And then whatever that interest rate is, so let's say it's 4.5%, you're going to get $1,000 plus 4.5% for that 6-month period or that 9-month period, whatever that period is, right? Whereas in the stock market, you can't guarantee any type of return, right? So you're putting it in hoping that over time you'll get more than that 4.5%, 5%, but there's no guarantee on that. So what you're doing is you're just managing the risk because rates are so high. You can take out some of your risky assets and move it into a more stable asset to know that you're going to get a guaranteed rate. So that's what happens when rates go up. And then the inverse happens when rates start to come down because now the cost to hold money for a short period of time or a longer period of time isn't as rewarding, right? So the risk to reward. So that's when you start putting money back into stocks or into longer term investments because now that reward isn't as great. So you're willing to take a little bit more risk to get a better return. So the short of it, when the Federal Reserve raises rates, there's generally an inverse relationship with the stocks. And that's just how money managers and portfolio managers are managing their money. They're pulling money out of risky assets and putting it into more stable assets.
Makes sense. Thank you for that. Okay. Next question here. Is it better to invest or to set up a 529? And perhaps, what is a 529?
Yeah. So 529 is a wonderful sort of tax shelter that the IRS created, the government created for people that have plans for college.
Mm,
So as you know, as a college student, you're probably paying an unfathomable amount of money for tuition, right? So in a way to help sort of defray some of those costs is we set up the government set up these 529 plans. So 529 plans are college savings plans. They're tax deferred, meaning you don't pay taxes on any kind of capital gains, right? And that's a huge gift that the government gives people because they want as much taxes as they can get, right? So a 529 is basically a college savings plan.
mhm,
But the trade-off to getting that tax deferred growth and a tax-free withdrawal is you have to use those funds for educational purposes, right? So
mhm,
if you, for example, I have clients that set up 529 plans for their children, um, and they put $10,000 in. That $10,000 grew to $35,000. So all that grows tax free, and that distribution when they take the money out is tax free as long as it's going for education, right? So
mm,
you can take that $35,000 to buy books. You can take that $35,000 to pay for tuition, um, to pay for lab fees, for things like that. But you
mhm,
couldn't take that $35,000 and go out and buy a brand new car, right?
mm,
So if you invest outside of a 529 plan, you don't get that tax deferral, but then there's no restriction on um, what you use that money for, right? So
mhm,
if you put $10,000 into a general investment account and that money did grow up to 35,000, you pay taxes over time, but now, you know, you see a brand new Audi or something that you like, and you have that money, you can go out and buy that Audi without any restriction, right?
mm,
So, but just keep in mind, 529 plans do have investments in it. That's how the money grows. So there'll be a number of different mutual funds that you can select within that 529 family, and that's how they're going. So it does have an investment exposure. It's just a tax code within the IRS tax guide, right? So
It's great to know because, tax-free assets is also really great as long as it's for the right, financial type of,
right,
yeah.
yeah. So it works similar to like an IRA, individual retirement account, right? You get that tax deferred growth,
Hmm.
which is
Hmm.
huge.
Yeah, that's great.
Yep.
All right. So what investments can a college student be looking into?
Yeah. So again, it all depends on your individual situation.
Hmm.
Um, the general rule used to be the younger you are, the more aggressive you can be, right?
Hmm.
So you can take on more risk. So usually, equities or stocks are associated with it being risky. They tend to be a little bit more risky, only because you don't know what's going to happen in the future, right? Like there's no guarantee when it comes to investing in stocks.
Right.
But it all depends on your situation. Diversification is always a good idea, but it also depends on your time horizons and the amount of capital you're going to put to work, right? So like if you have $1,000 to invest, and you don't need that $1,000 for another 10 or 15 years, yeah, maybe uh, a stock portfolio makes sense, right? But if you have $1,000 to invest, but you need that money in 2 years, well, maybe stock's not so much in this environment or any environment, but maybe more of like a sort of a short-term instrument like a CD, which we talked about, or a fixed income portfolio.
Hmm.
Um, but again, it all depends on your individual situation. But at the same time, the general rule of thumb is the younger you are, the more risk you can take.
Hmm.
Um, so yeah.
Good to know. All right. So what are the best platforms for entry-level investors?
Yeah, we get that a lot because one, I think you don't have a lot of assets to invest, right? So you're like, why would I
Hmm.
want to go hire someone to help me invest a
Hmm.
small amount of money, which makes sense, right? But again, as a fiduciary, I will tell you that, right?
Hmm.
But a lot of the entry level platforms that I see people, I don't haven't used these myself, but like a Robinhood, I think people are familiar with Robinhood.
Hmm.
Um, Acorn is another one that people use. Um, Web Bull is another great sort of zero cost trading platform. But, if you're looking to put like small amounts of money, like $500-600 in, just to see if you want to buy like an individual stock or um, a couple of stocks, like like Amazon or Tesla or Apple, things like that. I'm not recommending those, but that's what people generally look at when they're investing for the first time. Those platforms are good platforms to look at. But I also encourage you, if you are looking to invest for the first time, to maybe look at a mutual fund or something like that. A mutual fund is great because what you're doing is you're getting that diversification that you should have when you're investing, and you're pooling your assets with another group of people, right? So hence the name mutual fund. But like I said, it all depends on your individual situation, and this is where we encourage you to come in and talk to someone that knows, right? Because again, if they're a fiduciary, they'll tell you what's the best thing to do for you. But, like when I first started out investing, I was in college. I bought $1,000 worth of Orion pictures. They went bankrupt since, but I went to well, at the time was oldie discount brokerage, so you could buy like shares for like $10 a trade. So and those were the platforms that were available to me. It was either that or talking to my father's financial advisor at Prudential, which I didn't want to do, right? So, but starting out like Acorn, Webbull, Robinhood, those are some of the platforms that we see for entry level investors. But again, like I said, if you're not sure, if you're not, come see us. We can walk you through it. Yeah.
That's good. Yeah, I'm glad that there are more like sort of entry level platforms out there that people can check out. But definitely making sure to go speak with somebody about the individual situation is always a good first step.
Yeah, it does get tricky, right? So,
hmm
um, yeah. So, and then asset allocation. This is what we are talking about earlier, like the mixture in your portfolios, right? So, again, you have stocks. With stocks, which is equity, you become ownership. You take ownership of the corporation, right? You're buying shares into that corporation. So, for example, I own a lot of Nike stock because I love Nike. Again, I'm not making any recommendations, but so as a kid, I used to all I wore was Nike. I own a lot of Nike stock, so I share in the good and the bad of what happens with Nike. Nike said goodbye to Tiger Woods a couple weeks ago. Very disappointed by that, but I wasn't involved in that decision. But I share in that. If the stock pulls down because of that sort of relationship ending with Tiger, I share in that. But if LeBron wins another title and the stock goes up because he represents Nike, I profit from that as well, right? So stocks, you're owning, you're an owner, you're taking ownership in the corporation or whatever it is you're investing in, right? So that's why it becomes a little bit more risky. Bonds, you become a lender to the corporation or the entity, right? So like the state of Massachusetts, the Commonwealth of Massachusetts will issue bonds. Apple Corporation will issue bonds. And what happens with bonds? U.S. government issues bonds. You're becoming a lender to that institution, right? So what happens there is, if you have $1,000, you say to this, let's just say Apple, you're going to let Apple borrow money for a specific period of time. Usually it's 2 to 3 years, if not longer. So let's just say it's 3 years. You're going to let Apple borrow $1,000 for 3 years, and in return, they're going to pay you a coupon. So say 3%, 4%. That's the coupon. That's fixed. That's why bonds are known as fixed income, right? So every year that you let Apple hold your money, they're going to pay you 4%. So every year you get 4% given back to you on $1,000. So $40, right? But at the end of that 3-year period, Apple will give you back your $1,000. So for letting Apple borrow your money for 3 years, you get back $1,000 plus $120 worth of interest, right? So that's why bonds are a little bit more stable, a little bit more predictable. That's why they're fixed income. That's why they're generally considered a more stable investment, because at the end of the day, you're gonna get your money back plus interest, right? So that's what happens when you become a lender. And then cash and cash-like assets are, like your checking account, your savings accounts. Anything that's short-term, anything less than a year is a cash-like asset. So sometimes it's a little longer than a year, but generally that's what we look at, anything less than a year. But that 12 to 24 month period as well, right? So cash-like assets are like money market funds. CDs, certificate of
Mm,
deposits, which we touched on.
mhm.
And then there are other things like agency discount notes, UST bills, things like that. Those are shorter term vehicles that you're probably not going to tie up for a long time, but they're fairly liquid. So when we talk about asset allocation, that's very important in your portfolios and your risk profile and all that, right? So you want to make sure you have a good mix depending on what you're looking to do at the end of the day with your money. But
Mm.
that's what we talk about when asset allocation. And then within that, there are different sort of pie charts that you want to look at as well.
Gotcha. So when you talk about portfolio, you'd have like a mix of these different types of assets. Uh,
Exactly. Well, yeah. So some of the bigger portfolios, you want to have a little bit of everything.
mhm.
And then that's where an advisor can help you figure that out, like what the best mix is.
Gotcha. Well, great. Okay, another one here. Should I be looking to actively manage my assets or investments, excuse me, or passive, or is passive investment better?
Yeah. So I generally it's a combination of the two. I think actively manage is great if you're working with someone
Mm,
because they'll be there to take advantage of situations, either markets rapidly decreasing or markets rapidly uh, increasing. I went through the 2008 sort of flash crash. That's when we had the problem with subprime mortgages and all that.
mm,
So people remember that. But there was a day when the market just out of nowhere went down like 7-8% within the day, right? And that was like
mm,
that was a big move, and that scared a lot of people. But if you had someone there that was actively helping you, when to sell, when to buy, or making those decisions for you, like working uh, with discretion.
mm,
That's a different term that we can talk about at another point. But if you're actively managing those portfolios, you can take advantage of those things. Whereas a passive investment is more like buying the S&P 500 or the
mm,
Nasdaq 1000 or the Dow Jones 30. It's whatever happens within those indices. That's what you're getting, right? So if they crash, you got to wait for that recovery. If they go up too much, you got to wait for that. You're never going to sort of take those gains, right? And it's always good to take that gain, but in those passive portfolios, you're not doing that. So if you have a combination of two, it's good. But definitely, if you're going to have active, you want someone helping you with that part of it. So it's sort of like um, I like being out on the ocean. I like being on a boat. I can probably drive a boat when the seas are calm and it's a beautiful sunny day. But
mm,
once you start getting choppy waters or a storm's coming in, I have no business being behind that wheel. You need a captain that knows what they're doing, right? So
mm,
like when things get very volatile, you want someone that's in there to know to know how to react, right?
mm.
So that's why having active management is good. But again, like I said, there is some merit for passive, and if you're a small investor, or you're just looking to do like one-off things. Passive is not a bad way to go either. Um, but again, always talk to someone before you're
Mm.
going to do anything.
Yeah, that makes sense. Yeah, different situations, So
Yeah,
now, one term I have heard when it comes to investing a lot is dollar cost averaging. What is dollar cost averaging?
yeah. So dollar cost averaging is you have X amount of dollars to put into an investment at a certain time, right? So, like, say if it's every 6 months, every 9 months. So, um, many of you still in college probably don't deal with these yet, but a 401k plan, your retirement plans that companies offer, those are good examples of dollar cost averaging. So, like every paycheck, you're going to take aside 1% of your pay and invest it into your retirement account, right?
Hmm.
So, regardless of what's happening in the market, you're putting in that fixed amount of money in that interval, right? So, if the markets go up, you're participating. The markets go down, you're buying more shares or you're investing more at a lower rate, right? So
Hmm.
it's just you're using that fixed amount of money. So, for example, going back a little, when I was in high school, um, I had a car, but I only had $20 a week to put money in for gas, right? So regardless of what the price of gas was, I had $20. So I was just going to fill my tank with $20. That's it, wherever that got me. So like if the price of gas was high, I would get less. If the price of gas was low, I would get more. But whatever it was, every week I was going to the gas station with $20, and that's it. And then if I ran out of gas before the week ended, I had to stop driving. If I had extra gas, then that's great. I can go further, right? But um, that $20 is all I had, and that's what I was going to, whatever I was going to get for that. That's what I was going to get. So that's sort of how dollar cost averaging works.
Gotcha. Yeah, that makes sense with the market changing, but whatever your base level is how much you put in,
Yeah, exactly.
All right. Oh, there we go. uh, how should I change my strategy as I approach retirement?
Yeah. So again, it's all going to depend on your individual situation and what you think your retirement lifestyle is going to look like, right? But
Hmm.
um, generally, the way, and we talked about this earlier, the younger you are, the more risk you can take. Whereas as you get older, you want to take on less risk and have something that's a little bit more stable. So the general rule of thumb is as you approach retirement, you want to try to be in a little more stable of an investment portfolio, right? Because you want to start drawing against that portfolio. So
Hmm.
you don't want to see those fluctuations in your principal, right? But also, if you're looking to retire at 65, that's usually the general age. I think nowadays, especially when I get ready for retirement, it's going to be a little older. Probably when you guys are ready to retire, it's probably going to be closer to 75, right? But you want to look at your sort of how many more years after retirement will you need your funds? So it's sort of kind of a morbid way of looking at it, but what's your life expectancy, right? So if
Hmm.
you retire at 65, and the way demographics are now, most people are expected to live until like 92, 94, right? So you have 30 years of no income, right? So
Hmm.
how do you make that money last? So you sort of have to have a growth component to what you're doing, but also you
Hmm.
want something that's stable as well, right? So all the more reason you should talk to someone before you're approaching retirement, right? But yeah,
Hmm.
but the general rule of thumb is as you get closer to retirement, you want to look at things that are a little bit more stable, a little bit more predictable, right? Because
Hmm.
the last thing you want to do when you get into retirement is have to worry about going back to work or running out of money, right? Um,
Yeah.
and a lot of times I tell clients, like, you can borrow for anything except retirements, right? So you want to make sure you have a good plan in place. But, but yeah, as you are approaching retirement, you want to make sure that the pool of money you have set up for retirement becomes a little bit more stable, um, and you're taking on less risk.
Great. Well, thank you so much. That makes a lot of sense. That was the end of our pre-recorded questions that we have here. Before we get into any other sort of live questions, I did just want to do a small disclaimer. As we've mentioned multiple times on this presentation, this is just sort of for educational purposes, kind of generally speaking about a lot of these topics. If you would like something individually tailored for your own personal situation, we definitely recommend speaking directly one-on-one with an advisor or somebody who is more uh, uh, being able to speak directly to your situation. But we really like and are really glad to have Raj here to be able to talk about things in a general level, general advice, that sort of thing. I would like to now open it up for any other questions that people may have. If you want to pop those in the Q&A feature, we'll be happy to ask Raj here. I did have one, Raj, that maybe you could speak to, which is
Sure.
just, I know I hear a lot about when you're starting to think about investing, you want to first like develop a sort of emergency fund or
Yeah.
like a fund of money that's like for 3 to 6 months ish is what I've heard, just safety net kind of thing. If I've been able to save up to something like that, do I want to uh, only start investing funds that are in addition to that, or should I be taking some of that and using that as some of my investment thing? In case I know that you want to make sure you have that fund available. What would you say? Can you speak to something
Yeah,
like that?
so that's a great question. So yeah, you do want to have that. Like I call it a rainy day fund, right? So
Hmm.
at least 3 to 6 months of your expenses saved up in a very liquid account. So like your checking account or savings account, right?
Hmm.
And that's something you don't want to worry about what the returns are and all that because it's designed because if there is an emergency, right, you need to take money out quick or you know um, I've had friends gone through it where they lost their jobs and they weren't sure what the next step was, right? You want to be able to meet those expenses. So yeah, general rule of thumb is 3 to 6 months. So you don't want to start pulling those um, from those accounts to invest
Hmm.
because again, you're taking on risk, right? So
Hmm.
um, even though you say, well, I know I'm never going to need this money, but you just never know, right?
Hmm.
Last thing you want to do is set up an investment account because what happens there is it costs money. It's going to cost, and if there's a pullback in the markets, you never know when that's going to happen, right?
Hmm.
So if you had put $4,000 of your $6,000 that you have for an emergency fund into an investment, and then 2 weeks later you find out you need $4,000, well, there's a chance that those $4,000 aren't going to be worth $4,000 anymore, regardless of the type of investment that you're in, right?
Hmm.
So yeah, you don't want to put those funds into an investment. You want to do in addition to, right? So
Hmm.
um, so think of investing as a surplus to what you have, right? So
Hmm.
and part of the planning process is going through that, right? Just making sure we take a look at everything, and that's one of my roles as a fiduciary is taking a look at your overall picture, just to making sure that you can afford to invest, right? So
Hmm.
because it does cost money, um, and depending on the type of investment, there might be penalties and things like that involved as well, right? So
Right.
you don't want to have to throw away money for no reason, right? So yeah, you should always keep your emergency fund separate, and
That's good
then
to know.
yeah,
Yeah, thank you. Because you hear a lot of like, you should start investing like today, and if not today, the best day was yesterday or tomorrow
sure,
or whatever it is. You can hear that sometimes, and I feel like it's
right,
easy to start to panic and be like, "Oh, am I wasting my funds?" But like knowing that even at the top level, everybody recommends making sure you have that safety net, making sure you have some funds easily accessible to you, is what everyone should do. So that's really
yeah,
great. Um,
exactly, great.
Cool. Good to know. All right. Well, we do have another question here, looks like, which is, how do you receive tangible value from investment stocks? What does it mean to sell your stocks?
Um, yeah, so tangible value would it's all about supply and demand, right?
Mm,
So that's the basics of it, right? So if you have shares that people want and they're not selling fast enough, that's what's going to drive the price up the stock, right?
right.
So, so for example, Tesla, everyone, at least a few months ago, everyone loved Tesla. So that's what happens on those markets, those exchanges, like on the Dow Jones or the Nasdaq, the S&P. You
Mm,
have traders going back and forth bidding for shares, right? So there's only X amount of shares that are available to trade, right?
mm-hmm,
So that's what helps create the market cap for a company. So like companies aren't giving out all their shares, because they want to keep ownership. So whatever is available on the open market. So that's sort of creating a tangible value is the demand for that certain stock, right? So if more people want to buy the stock, the value of the shares are going to go up, right?
mm-hmm,
And then selling is just a matter of um, what platform you're using, who you're using. Like if you're working with an advisor like myself, we would talk about it, and then I could go out. I have access directly to the exchanges through my trading platforms, and say, all right, Ty, you want to sell 100 shares of Tesla? Um, this is what we're going to do. This is the price. This is what we're going to get for it. This is what you're on that, right?
mm-hmm,
If you're using Robinhood or a Fidelity, they might not consult with you on that. Like you're going to do it on your own. But
mm.
whatever platform you're using, that's how you can um, sell stock. Yeah.
Gotcha. And does that usually take some amount of time to go through, like finalize?
Um, yeah, I mean, it's usually pretty instantaneous. So,
Cool.
especially now in the digital world, but it all depends on the platform. So another reason why you want to sort of, especially if you're dealing with larger sums of investments, you
Mm-hmm,
want to have someone that's on the inside to help you.
mm-hmm,
So, for example, going back to that 2008 example of the flash crash, I had friends that did everything on their own, and they tried to call. I don't want to name companies, but they tried to call certain companies, but their switchboards all crashed because everyone was calling at the same time. Um, Whereas I had a plan with my clients, and I was able to get to our trading desk right away and say, okay, we need to start liquidating some positions, right?
mm,
So, um, in normal sort of calm fashion, everything will happen instantaneously.
mm-hmm,
But like in those like very volatile moments, there's no guarantee in anything, right? So, but yeah,
right.
with digital trading now, it should be just a matter of seconds before you can buy or sell anything.
That's great. That's good to know. Okay, well, I think that's all of our live questions that we've had so far. So thank you all so much for coming. And thank you, Raj, again. This has been really enlightening. I feel like even I learned some things, which is
Oh,
great.
great.
Uh, so thank you all for coming to Wintersession 2024. This was our final presentation. If you have any other questions or would like to follow up, please make an appointment with Raj here in the branch, or feel free to stop by anytime. We have all sorts of different types of products and stuff. We'd love to see you. We'd love to hear from you. Um, we have a lot of different social handles here, so feel free to follow us if you'd like. We do all sorts of community engagement, all sorts of different events and things like that. We even have a survey that we have for all of our webinars, that because I like personally read each and every one of our survey responses to make sure that the content we're creating is reaching the right thing. And if you guys think we could be like improving or doing anything different, please do let us know. We'd love to hear back from our members and from our community. So thank you all for coming, and thank you all for being here. Thank you, Raj.
Thanks, everyone.
Bye now, everyone. I hope you have a good rest of your very cold day.